Hi, I'm Tim Kelly from Montgomery Investment Management, and welcome to this week's Video Insight. At the end of September, we passed a small milestone at Montgomery. Exactly 12 months earlier, we had launched a revised investment strategy for one of our smaller investment funds, the Montgomery Alpha Plus fund. Alpha Plus is an unusual fund in the Montgomery stable for a few reasons. Firstly, it's an equity market neutral fund that aims to generate returns without any net exposure to equity markets, and in that way produce a return stream that is not correlated with equity markets. Secondly, 12 months ago, it became the only Montgomery fund to essentially be run entirely by computer models. Prior to October 2018, the fund chose stocks based on a combination of computer model and human overlay, and it invested only in Australian equities. The intention of the human overlay was to tilt the fund towards high-quality stocks, which we think is a sound strategy for a patient long-only investor. But in a market-neutral fund, especially in the Australian market, it can cause problems. For example, if you're a long-only investor in Australian stocks and you are underweight resource stocks because you don't think the quality is there, then you miss out on some upside when those stocks rally strongly, as they have done in recent years. But that doesn't stop your portfolio from rising if the stocks that you do hold are also going up. Most investors can tolerate a more modest return from their portfolio some of the time, especially if it means a better long-term outcome. However, in a market-neutral fund, being short resources stocks when resources stocks rally strongly is a different kettle of fish. Rather than causing the fund to rise more slowly than it otherwise would, being short the companies that are rising quickly can cause a market-neutral fund to go backwards, and that's a much more challenging proposition for investors. In light of this, a year ago, we removed the human quality overlay for the Alpha Plus fund, and we gave the computer models free rein to invest globally. Following that change, the computer models analyse more than 4,000 stocks around the world every month and select around 300 of them to include in a carefully constructed portfolio designed to achieve a positive return with relatively low risk, regardless of whether equity markets are rising or falling. 1 year is too short a time frame for a meaningful analysis of fund performance, and we expect the returns will vary considerably from month to month. But 12 months in, the early signs are encouraging. In this time, the fund has beaten its benchmark and kept its promises in terms of correlation with equity markets and its overall level of risk. Our analysis leads us to think that the current computer models should do a very good job for investors over the long term, and we think that with continued investment in systems and resources and research, we can continue to improve them for many years to come. Alpha Plus is a small fund, but we think that for investors who are alert to risk, it offers a very appealing return profile, and we're excited at what it can do over the long term. So, happy birthday, Alpha Plus. That's all for this week. We'll be back with more next week, and in the meantime, you can follow us on Facebook and Twitter.